global economy continues to recover as growth momentum strengthened in the first 2 months of 2018. The investment-led recovery was aided by favorable financing costs and improved business confidence, providing a substantial boost to capital and consumer spending, pickup in manufacturing activity and trade, with support from accommodative monetary policies. Whereas the ongoing expansion is robust in the advanced and emerging market economies, growth remains modest in sub-Saharan Africa, as the 3 large economies of Nigeria, South Africa, and Angola gradually recover. Global inflation is on a gradual upturn in advanced economies, although core inflation remains subdued. This latest development, combined with the closure of output gaps and stronger wage growth in some advanced countries, could lead to faster monetary policy normalization. Prices of Ghana's main primary products on the international commodity market have rebounded somewhat over the first 2 months of 2018. Crude oil prices have gained the most since the fourth quarter of 2017, reaching $69.1 per barrel in January 2018, but have since moderated on the back of increased production and rising U.S. shale output. Gold prices have also performed better, largely driven by a weak U.S. dollar and steady purchase and holdings of gold by central banks. Following some price depression in 2017 on account of excess supply, cocoa prices are gradually on the mend. The main price drivers are strong grind data from Europe and renewed concerns over adverse short-term weather patterns across the West African sub-region. Broadly, these developments in the external environment continue to transmit favorably to the domestic economy. On the domestic front, the trend decline in prices observed in 2017 continued into the first 2 months of 2018 in line with the bank's forecasts. Headline inflation dropped sharply from 11.8% in December 2017 to 10.3% in January 2018, before edging up marginally to 10.6% in February. The uptick in February was occasioned by the upward adjustment of ex-pump prices of petroleum products, following rising international crude oil prices. These developments reflect entrenching macroeconomic stability, continued tightness in policy stance, and relative stability in the exchange rate. Since the last MPC meeting, all of the bank's core measures of inflation broadly declined, suggesting subdued underlying inflation pressures. The bank's main measure of core inflation, which excludes energy and utility, declined from 12.6% in December 2017 to 11.3% in February 2018. Also, the weighted inflation expectations by businesses, consumers, and the financial sector derived from the bank surveys continued to decline, indicating that inflation expectations remain well anchored towards the medium-term target of 8 plus or minus 2%. Initial evidence from high-frequency indicators showed that the growth momentum experienced in 2017 has continued into 2018. The Bank of Ghana Composite Index of Economic Activity grew by 3.1% year-on-year in January. The bank's confidence surveys conducted in February also indicated positive sentiments on growth prospects, realization of business expectations, and general improvements in the economy. The pace of growth in key monetary aggregates has continued to moderate, consistent with contained aggregate demand pressures. Annual growth in total liquidity slowed to 12.5% in January 2018 from 26.7% a year ago, also partly reflecting the reduction in the number of banks in the monetary survey from 34 to 32. There is also a gradual downward migration of all money market interest rates, as well as realignment of the yield curve in line with the monetary policy stance since March 2017. The interbank rate, that is, the rate at which commercial banks lend to each other, declined further to 18.3% in February 2018 from 19.3% in December 2017 and 25.2% a year ago. Also, the interest rates on money market instruments declined, especially at the short end of the market. In February 2018, rates on the 91-day Treasury bill instrument dropped to 13.3% from 15.9% in February 2017. Similarly, the 182-day instrument declined sharply to 14.9% from 18.5%, while the one-year note also fell to 15% from 19% over the same period. The recovery in the private sector credit is still slow. Credit to the private sector grew by 11.7% in January 2018 compared with 15.2% a year earlier. In real terms, private sector credit expanded by 1.2% against 2.1% growth in January 2017. The latest credit condition surveys also showed overall net tightening in credit stance to enterprises. This was attributed to banks' current and expected capital positions, as well as changes in the share of adversely classified loans. The credit stance on loans to individuals also tightened as banks continue to repair their balance sheets. The ongoing regulatory reforms in the banking sector are to promote stability of the financial system and to properly position it to support the economic growth agenda. The banking sector as a whole continues to be liquid, profitable, and solvent, with some modest gains in asset quality. However, there remain a few vulnerabilities, and the Bank of Ghana expects banks to continue to implement their recapitalization plans in line with the new minimum capital requirement. The total asset base of banks increased to 95.1 billion in February 2018, indicating an annual growth of 13.7% compared with 15.3% recorded in December 2017. The asset growth was mainly funded by deposits, which went up by 12.6% on a year-on-year basis. The industry's capital adequacy ratio improved to 19.2% in February 2018, reflecting efforts by the banks to recapitalize. Other financial soundness indicators recorded some improvements. Although the quality of loan portfolio remains a concern, the non-performing loans ratio remained unchanged at 21.6% since December 2017, as banks continue to clean their balance sheets. However, adjusting for loan loss provisions, the NPL ratio drops to 10.9% in February. Provisional data on government operations indicated an overall budget deficit of 6% of GDP in 2017 against the end-year target of 6.3%. Total revenue and grants was 20% of GDP, below the target of 21.3%, and total expenditures, including arrears clearance, was 26% of GDP, below the budgeted estimate of 27.7%. The total public debt declined from 73.1% of GDP in December 2016 to 69.8% of GDP at the end of 2017. Of the total, domestic debt was estimated at 66.7 billion cedis and the external debt was 75.8 billion cedis. The maturity profile of domestic debt showed an increase in longer-dated instruments, in line with government's debt management strategy, in particular, the reprofiling strategy. By the end of December 2017, the share of short-dated instruments in total domestic debt had declined to 18% from 37.6% in December 2016, while the share of medium-term instruments rose to 63.1% from 38.1%. Provisional data for the first 2 months of 2018 indicated a trade surplus of 584.5 million on the back of higher export receipts from crude oil. This compares with the trade surplus of $494.3 million recorded over the same period in 2017. The trade surplus is expected to translate into a current account surplus in the first quarter of 2018 and further into a strong external position. There was a drawdown in international reserves, largely reflecting seasonal foreign exchange flows, planned sovereign bond coupon payments, and the Energy Sector Levy Act related payments. As a result, gross international reserves stood at $6.9 billion, that is 3.8 months of import cover, as at March 20th, 2018, compared to $7.6 billion, that is 4.3 months of import cover, as at December 2017. The foreign exchange market has remained calm over the first quarter of 2018 on the back of subdued demand pressures alongside improved foreign exchange liquidity. Cumulatively, the local currency has appreciated by 0.2% against the US dollar in the year to March 2018, compared with a depreciation of 5% during the same period in 2017. In sum, the committee observed that the pace of global growth has firmed up. Though price pressures are picking up, core inflation in most advanced economies remains subdued. Global financing conditions still remain favorable, sustained by relatively low interest rates in most advanced economies. The outlook for growth in the near term is for continued robust expansion towards growth potentials as output gaps gradually close. These notwithstanding, downside risks to global growth exist, including the abrupt tightening of global financing conditions and escalating trade protectionism and geopolitical tensions. The strong path of fiscal consolidation in 2017 continued in the first quarter of 2018 with the continuation of the allotment system, which aligned expenditures to revenues. Growth prospects for 2018 remain positive and are expected to be supported by crude oil production, gradual recovery in non-oil sector, and favorable business and consumer sentiments. The pace of growth in economic activity, as reflected by the latest update in the CIEA, showed some improvements, although still below potential for a number of reasons, including moderated credit growth due to high NPLs, tighter credit conditions, and corrections in the balance sheets of the banking sector. The disinflation process continued to firm up over the first 2 months of the year, with significant moderation in price pressures. Both headline and core inflation broadly trended down, alongside easing inflation expectations, an indication that the disinflation process remains well anchored. Our latest forecast suggests that the medium-term inflation target of 8 plus or minus 2% is within the forecast horizon, and we are on course to meeting the inflation target band. The committee noted that the current inflation forecast provides scope for monetary policy to realign interest rates translate the disinflation gains achieved so far to the market, and reinforce the fiscal consolidation process by easing the burden of interest payments on the budget. Under these circumstances, the committee decided to reduce the monetary policy rate by 200 basis points to 18%. Thank you.